Alrighty, folks, I apologize for being a couple of minutes late. It was completely my fault. I actually started doing a recording instead of hitting a live. A little brain cramp this morning. So totally my fault. I apologize for being 3 minutes late, but let's get into this discussion. I have a treat for you this afternoon. You have the opportunity at 4 p.m. Pacific to hear from Tom Nash. Tom Nash is affectionately called the Palantir guy, and we talk about what he saw early, the research he did. We talk about a balanced portfolio, dollar cost averaging, and the fact that Palantir, yes, the great and almighty Palantir, might drop 50%. We talked about nobody went broke taking a profit and a lot of great stuff. One of the things that hopefully you see in the Tom Nash conversation is that he is wicked smart. His ability to recall information is next level. He went to school, got a JD or a law degree, an MBA. He is way smart, way smart. Do be warned that if you do have kids and you listen to my videos with your kids around, this one you might want to put in the earphones for. There is not a lot, but there is some adult language, as Tom Nash is known to get passionate and occasionally let a adult word slip. So just be warned on that one. But that said, it's not a lot. And there are so many gold nuggets in that conversation with Tom Nash. I do want to shout out Spencer for helping us make that happen. Greatly appreciated, man. And hopefully Tom Nash is somebody who comes back on the channel because he was a fun conversation. So let's get into some Fed speak. We have the one and only Jerome Powell actually speaking right now. I do expect a lot of his stuff to be market moving. I got a couple of quotes before the live stream started, so we'll talk about Powell. But I want to talk about the other Fed president that spoke this morning, Hammack, as she is highlighting some important things, again, that you and I should be paying attention to. First and foremost, it is important to look at the net effect of new government policies, right? There's a lot of chaos, right? I warned you the first 6 months of this new administration would be very chaotic. There would be a lot of chess moves. You and I would not understand the chess moves. It is not helpful to react to any single chess move. And Hammack is basically saying the same thing. Let's look at all the policies in totality, because that's how it will work through the economy. Fed President Hammack says we got to get inflation to target. It is paramount. What that translates to is they've not given up on 2%. The economy is in a good place and the job market is solid. Again, no March rate cut. We've been on that one for a minute. Monetary policy is only modestly restrictive. I think that's a sign that the neutral rate, R star, whatever you want to call it, probably has a 4 handle on it, not a 3. I think if you go back in time, the Fed was trying to paint the picture where the neutral rate had a 3. I disagreed with them then, and I think they're coming around to what your boy believes, that it has a 4 handle on it. Finally, inflation risk is skewed to the upside. Skewed to the upside. Again, that is important. We did see a very large and dramatic increase in inflation expectations. I think you have a video from Taylor and I talking about that this morning. I think it comes out at 10. But again, inflation battle not over. It'll be interesting to watch CPI tomorrow because, again, remember, CPI, the base effect, all of these things that we've been telling you are coming are finally here. We have 3 months where the base effect is expected to be positive, meaning drop a big number, add a small number. And as of right now, the expectation is both CPI headline and CPI core drop by 1/10. I am not as optimistic about that. I think there is a chance that at least one of those metrics does not drop, which will point to inflation being a lot more sticky. But we will see in about 24 hours. And then finally, the comment from Hammack should finally put to bed a March rate cut hopes. It is likely appropriate to hold rates steady for some time. Again, I think what Hammack is telling us is stop asking me about rate cuts. We've got to get to June at a minimum. to see what is going on. Now let's talk about Powell. We will undoubtedly have more Powell quotes tomorrow for you. But given his Fed speech just started talking, I only got a couple of quotes before we went live. Number one, the Fed does not need to be in a hurry to lower interest rates further. Again, for those out there calling for a March rate cut, hopefully that quote put that to bed, because that's not coming. We can ease policy if labor market weakens unexpectedly or inflation drops faster than expected. So Jerome Powell, the man at the top, is telling you explicitly what it's going to take for the next Fed rate cut. And good news, folks, we get numbers weekly on the job market. We get numbers monthly on inflation. So the chances of a March rate cut should be out the window. Talking to Taylor the other day, was about an 8% chance of a March rate cut. I would expect those odds that were already single digits to go even lower. Let's talk about Mike Simonson talking about what is going on in the housing market. And again, remember my call that housing will be sub 4 million transaction, rates will be higher than expected. All those things you've heard me talk about. So what's going on a week-to-week basis? Number one, Mike Simonson is questioning, has stated seller growth lost momentum. That's important, folks. We are in the start of the spring selling season for some areas of the country, and sellers are not listing as readily as last year. Last year, we had 66,000 new listings. This year, 64. Again, that may not seem like something that's important, but again, with rates over 7%, the move-up buyer, the seller and the buyer, is just not playing. They are not selling. They are waiting for a better time. Active inventory actually ticked down. Folks, we are in the spring selling season, and we have seen active inventory tick down slightly 2 weeks in a row. That's not normal. Active inventory is, however, up 27.8% year on year. But again, remember, active inventory week on week, 2 weeks in a row, fell. That's not normal. Price cuts are ticking up. Price cuts are tipping up. And that is actually why some sellers might be holding back, right? If you are thinking about selling your home, but you are seeing your neighbors take price cuts to move inventory, maybe you just want to wait for better times. So in summary, this is Mike Simonson's summary. Fewer sales, weaker demand, and sellers waiting for better conditions. Folks, this is exactly how you get less than 4 million transaction in this last hard year of real estate. Let's talk about the Small Business Optimism Survey. This is something we gave a shout out the last couple of months because it exploded higher. It actually came in at a peak of 105.1, which was the highest on record. It came down. It was expected to go down to 104. It actually went down further to 102. What do these numbers mean? Don't worry about the numbers. Worry about the trend. Worry about the history. So here you go. One, even at 102.8, which is lower, significantly lower than last month and lower than expected, it is still above the historical average. That's good. Also note that the previous 2 months were the largest gain on record since 1985. Now, what is tripping up this survey, making it go down from where it was? Well, it's really twofold. Inflation is the top concern. Obviously, we have seen in the last 30 to 45 days talk of tariffs, talk of this, talk of that. The small business survey really highlights that small businesses are concerned about tariffs equaling inflation. Makes perfect sense. Lastly, the thing that drew down small business optimism was CapEx, their ability or likelihood of making significant investments in the future. CapEx plans dropped 7%. Again, I don't think there's any concern in the survey itself. Small business survey is still above average. It's still in the top 3 or 4 optimism numbers. It's just lower than it was. What else do we got? We got Goldman Sachs. Goldman Sachs CEO talking about the Trump administration is going to drive a growth-oriented agenda. I don't think there is any question. Promises made, promises kept. That is President Trump's focus, and it's just going to be chaotic. It's going to be noisy, as I've highlighted since the election. Expect 6 months of chaos. And congratulations, folks. We're about 1 month, not even 1 month. What, 3 weeks? 3 weeks into this. I think the chessboard will become more obvious as time goes by. But again, nothing has made me change my mind about the 6 months being chaotic. We did get a couple of earnings. We got Coca-Cola out this morning, actually crushing expectations. Wow. They beat top line, which means they sold a lot of Coca-Cola products. They beat bottom line, which means they had a lot more profit than expected. So again, Coke beat Shopify. Shopify was another earnings this morning. It hit revenue targets, but it missed on earnings, meaning they didn't drop enough money to the bottom line, which was interesting. It appears that roughly 60,000 federal workers, or about 3%, have accepted the 8-month offer. Again, get paid for 8 months, but quit kind of thing. It's estimated to be about 60,000 folks, or 3%. Well, let's talk about tariffs and the impact on real estate. I think I got that question twice yesterday in DMs. So when I think about tariffs and I think about housing, there's really two things that I think about. First, I think about the impact on rates. And the impact on rates may not be obvious because it's not direct. The impact on rates would come from, in my opinion, inflation expectations. Again, I remind you what happened in the small business survey. Inflation is their top concern. So what do I mean by watching inflation expectations? Well, most recently, I believe it was reported last week, inflation expectations over the next 3 and 5 years have taken the largest jump in recorded history. And that is not a good omen. So tariffs can impact inflation expectations. If consumers and businesses start to operate with inflation expectations higher, it will undoubtedly yank rates higher. Number two, tariffs, if implemented, if enforced, if stay for a long time, will have, at least in the short term, 6 to 12 months, as capacity is built in the U.S., have prices of building materials go up. If you're sourcing half the lumber from Canada and the steel from here and this and that, and there's no American capacity available to do that, prices will go up. Again, when I think of housing, that is what I think about. And I want to give a shout out to Jared, one of the 6 accountability groups that we run in our school community. He sent me some notes about what was talked about the other day. They talked about leveraging a property manager or a leasing agent to fill vacancies. Again, I love the fact that our accountability groups go into what the audience is important. They talked about qualified opportunity zones and had a review of bonus depreciation and cost segregation. So folks, if you're interested in building wealth in real estate, you either have 0 or 1, you're stuck in the first 5 years, or you want to be in a community with other players, it is time to join our school community. Our school community is 67 pennies a day. There are 361 or so folks in there. I hope to see you in there. It is the best place to be for real estate. For me, this is like Bigger Pockets 1.0. Back when I was writing for Bigger Pockets in 06, 07, 08, whenever that was, it was very much that community feel, very much all of us wanting to help and go in the same direction. If that is something that you want to be a part of, it's 67 pennies a day, $20 a month. If you don't like it, drop out. No skin off my nose. It is not a yearly commitment. So join, get the free education, all of that good stuff, be around people doing the right things. And folks, we're 4 days away. 4 days away from our Vegas event. And yeah, it's going to be fun. All right, folks, don't forget to buy your virtual ticket, $99. Be a part of it. Like, subscribe, comment, and enjoy the Tom Nash interview. It was a lot of fun. Take care. Bye.